to, you might get a little notification there that we are recording. And we're also just going to go live real quick on Facebook. So just catching everybody up. Right, the week before Christmas, we are here and still talking about our favorite topic of real estate investing. Usually the last Thursday of the month, we moved it up a week this month. I hope everyone's having a great holiday season right now. We've been super busy with our real estate investments this time of year. And we are really looking forward to next month. We've got a couple people lined up that are really interested in talking about multifamily as real estate investments, which is not a topic that we have really taken a deep dive into yet. So next month, keep that in mind. That's, I think, what we're going to be planning to focus on. But this month, a really great question came up to us, which I'm so happy to get to talk about because there has been so much change, quick change that has been happening in the real estate market in 2023, particularly regarding interest rates. So we thought that would be a really great topic for us to just mastermind around, answer questions around, talk about ideas and things that we're seeing and projections. And of course, no one has any crystal balls. If we did, we'd be much, much richer and more famous. But we'll do our best to talk about what we do know and what we might be able to expect. So thank you for joining us tonight. How are you doing, Anthony?
Doing great, doing great. And yeah, I think I want to start off talking about a little bit. We were coming on, and the media just loves to talk about interest rates, right? And it's the hot topic of everyone's, dinner table. It seems like lately when it comes to real estate, because it's really the only thing the media talks about. But what I'm always wondering, what I'm hearing that is what that actually means for the market. And it's been interesting to see this year, for example, where there was so much hype about what was going to happen when the interest rates rose, right? And so many expectations set by people and predictions. And most of them, really the major one, that prices would come down and that there really would be no more demand, was completely false, right? Which was interesting, number one. And the idea that there was going to be even less transactions that there are was even less. So it's kind of we try not to pay too much attention to that, but we can only offer kind of what we're seeing on a daily basis and inside
So
the market.
can I ask you a little bit more about that, Anthony? For people that aren't selling homes every single day, looking at your typical home buyer that might have been looking for homes, or typical investor that might have been looking at investments last year, and the cycle that they went through mentally, or how these news stories affected it, or how the behavior was actually affected by what was going on. Take us through what you actually saw happen, not what the media said happened.
So I'll talk about it from a client perspective and then my own personal perspective. Interest rates really only affect, assuming that prices stayed relatively where they are, which is true, right? And demand stayed relatively where it was. Interest rates really, from an investment standpoint, they really only affect the ability for the property to cash flow, right? So if you're buying a property at 5%, what your income is going to be, your return on investment is going to be very different between to buy a property at 5 versus, let's say, 7.5. And what we saw for even secondary homes and actual investment properties, they were even as high as 8.5, 9% at some points for people, right? So from a personal perspective, trying to make investments work and make sure that they're a good return, it became very, very difficult for properties to cash flow. So in the past, where we're going, let's say back to 2021, where you can make a property cash flow putting down 10% or 15%, it really was almost impossible to get a cash flow. You had to be more than 35 to 40%. So what we saw, the first thing that we saw was they had to put more cash into deals in order to actually get a return on your money that was decent enough for you to buy it versus putting your money into a savings account or a mutual fund, right? So that's something that I saw from my personal spot. When it came from an investment standpoint, I think that a lot of investors, and this goes back to what I was mentioning about the market, they were almost excited for interest rates to rise. So there'd be more cash opportunities to buy properties at a lower price, right? Because we're coming off a year where it was all about too much demand, too many offers. Might be an investor bidding on a house, but there's 5 people that are going to bid it and fix it up and live in it. So you can't compete price wise, right? But the idea was that prices would come down and there'd be more opportunities to buy things at a lower price. So earlier this year, that was a lot of the conversation that we had with investors. And then as the year went on, where we kind of realized that wasn't going to happen, which is crazy, right? But it really didn't happen. Prices did not fall for the most part throughout the country. I think it turned into more of a, well, I still want to invest. I'm still looking to do, whatever my goal is, buy a property for a short-term rental and eventually live in it, or flip houses, whatever. I still want to do that. How can I adapt in the market? And, obviously we recently saw that unemployment rose a little bit in these things, but a lot of the investors still had a lot of liquid cash that they were looking to do stuff with. So that demand was still kind of there. So I know, we turned into trying to creative finance deals and figure out other options and other financing solutions when the rates were so high, and they still kind of are, that investors don't love. So it was kind of those two things. It was getting over that initial jump and that prices weren't going to fall, and then being able to say, okay, I still want to buy. How can we get creative about it?
I was just going to add, I like having these conversations because it also jogs my memory, in the day-to-day aspect of things. We had to go, it brings me back a year in time and thinking about all the conversations that I was having last fall and up until Christmas of last year. So many people, particularly that were looking at the beach market, every single conversation that I had was, we're waiting for prices to come down. We're waiting for prices to come down. We're waiting for prices to come down. And, oh yeah, we're watching, we're liking what we're seeing. And they're just like on the edge of their seat, waiting and waiting and waiting for prices to come down. And we saw a small dip in prices last December, and everyone expected that to be the beginning of the decline. And what ended up happening was they ended up coming right back up again, not at the same levels that they were. Certainly the levels are significantly lower of appreciation and much more standard, for lack of a better word, of what we typically see as far as appreciation goes. But for some of those people, it was just because they wanted a place to come on the weekends. Maybe they ended up renting something that year, or maybe they ended up not coming and taking their beach vacations, or places that they're going to gather with families on the weekends. But a lot of those same people are still looking, are still out there looking on the sidelines, did not see the prices decrease as they had expected to, made other plans. I'm not sure what they're doing with their money right now sitting in the bank. That's not something that they typically share with me. I'd love to know the answer to that question. Actually, I'm going to start figuring out a way to find out that more. Like, what's the alternative that you decided not to do with that $500 or $1 million that you were looking at buying a beachfront condo with? But at the moment, there's a lot of those people that are still out there and did not achieve the low prices that you were just talking about, Anthony. So I just, it brings back just kind of that emotional aspect of it too, and kind of that emotional roller coaster of the real estate buying process. And it's a little bit different than buying other things because it affects so many different pieces of our lives.
Yeah, and I would finish up by at the end of the day, people who really had a goal of buying and it was an immediate need for them, the interest rates didn't really affect them. It just became part of the process. But if it was somebody that really didn't have a real need to do it, or they were still just thinking about it, they might have only been on the edge of their seat because all their friends and people that they heard of were buying at the time because the rates were so low. And it became this boom era. And real estate investing on every level became more popular because it was easy to get capital and it was easy to make deals work. Rents were rising and rates were staying low. And it was easy to put more numbers on a property and say, wow, I can make a couple, extra dollars a month. where now it's more difficult. So, and it's like, I say this to sellers when they're talking about if it's a good idea to list the house during Christmas time. As long as the demand is there and it's consistent, which it is, you're just going to weed out people who aren't really ready to make a move yet. But people who are, they're going to do it whether the rates are low or not, if they have that demand. And there were a lot of people that were still capitalizing on high property values for maybe selling properties that they inherited or they rented maybe just to a family member or something that hit huge property highs in the last couple of years, and they had to do something with that money. So I think that's another, thing that we did a lot of deals off of that this year, of people doing 1031 exchanges.
Yeah.
Right, for tax benefits, which we'll talk a little bit more about today. But I think that gives us a good idea of what we're expecting for 2024, the topics we can talk about today. And we're also going to hop into the short-term rental market predictions, because that's an interesting topic going off of the first time for a very long time when the media was saying Airbnbs are down and people aren't renting them as much, right? Which we saw in the last couple of months, but turns out it's not really the case either. So.
It's not.
Nope, which we're going to talk about now.
I just want to slow you down for a second and ask the Shelleys, do you have any questions? Anybody have any questions? It's interactive, so if you do have a question.
Yeah. Oh, we were just putting our mic back on.
Okay.
No, it's as if you guys are speaking to us and you're describing our situation almost to a T. Maybe that has to do with so many conversations we have had over the past several months about this topic. The Fed is a big thing right now, the interest rates, just as you were hitting on. You mentioned something about, what was it, a 1031,
1031, yeah.
I definitely want to hear about that. And then you were describing or mentioning about having to come up with creative cash deals or partial cash. In my mind, I'm thinking partial cash, partial mortgage deals, and that's exactly the situation we're looking at. And Amanda, we can talk offline about what people actually do with their money when they're not investing it in real estate and they want to, but we don't need to get into that right now.
Well, it's funny that you say that, but even last month, when we were having our seminar with Brian and talking about the financing aspect of it, it's always, every single time we have the conversation with each other, with other people, it's such an interesting topic. And once you get into this kind of real estate investing world and you get this bug and you start having conversations with all types of different people, there's a little bit of an addictive element to it. And so many people have so many different ideas and ways of looking at things, and it's so educational and really interesting to have. So yeah, feel free to jump in, ask any questions that you have. And sometimes from month to month, we cover the same kind of idea, but maybe in a different way, or when you have someone else that interjects something, it takes a whole different spin on it. So it's all so helpful. And I think we also, as human beings, hear things differently, sometimes the first time or the second time or from someone else, even if it's the same concept. So it's always very helpful. And a lot of these things, one day it just kind of clicks, and the way that it ends up working makes someone act or do something in a different way that really makes sense for them. And that's our ultimate goal here, is to help people find that missing link of whatever it is that they might be looking for.
And I'd be happy to explain a little bit more on those 2 points that you mentioned, John. So let's start with the 1031. So when it comes to an investment property, if you have a property that you bought, let's say for $100,000, and you haven't lived in it for, let's say, 2 years, you've owned it for less time, whatever, you're gonna have large capital gains when you go to sell that property. So when we had such a fast increase in property values, let's say from 2015, we can even say 2011 to 2020, the amount people wanted to sell, they had these homes that was inherited or whatever, or they invested in the time and never thought the property would ever be at that number. But because of that major price jump, that's why transactions went so high at that time. It sparked a new flame for people to sell that property, that investment property, and maybe buy something more ideal for them. But what was holding them back really is the capital gains that they would have to pay on that property unless they put their money into something else, right? So a 1031 exchange allows an investor to, or allows a seller to take the capital gains on that property. So let's say you bought it for 100,000, you sold it for 500. You might have had, a bunch of other expenses in there, but for argument's sake, let's just say you had $200,000 in capital gains. You can take that $200,000, roll it into another property if you identify it in 120 days of closing that property, and you can have 100% tax write-off on that property. So let's say you were selling an investment property up here, for example, you had a second house, whatever, and you wanted to roll it into a house you're going to retire in or something. That's more for your needs at the time. You would pay no capital gains on it, which is huge because that's a 25% return, at least on your money off the bat. So that's a way, going into the next topic, that a deal you can make it make more sense for you and stomach maybe a higher interest rate at that time or whatever. But because of that tax advantage, that's popular. And 1031s, when the market is high, they're always popular in the investment world. But when property values jump at a fast rate, they become extremely popular because everybody now wants to sell that property. That's their thorn in their side. They don't want anymore, but they would have sold or whatever. And this is the time because the property values high.
And just one quick little disclaimer here. We have to say we are not tax advisors. So we always encourage you to consult with your own tax advisor. 1031 exchanges are deferred capital gains tax. So eventually there comes a time and a place where that tax can come into play in your world, whatever that might be. But it is also fantastic tool for moving up different levels of property. So the way that I have seen a 1031 exchange be used very well is, for instance, starting off in an investment market, in a vacation market that is an appreciating market, maybe a newer market. And, someone starts off with a smaller dollar investment. And when that investment appreciates, rather than take their money out, rather than just keeping and going to their same studio condo that was on the ski slope that they went to, their family grows, their needs change, the rental market changes, they can actually use that appreciation, use the change in their income, use the change in their lifestyle, whatever their case may be, and then maybe roll it into now a 1-bedroom and then a 2-bedroom, or an older 1970s ski chalet that becomes then a newly built new construction ski chalet. And so by doing the 1031 exchange, they're not actually pulling their money out, but slowly over time, moving up their level of investment into maybe something else that they enjoy more or can use more or get more rental income out of, or ultimately maybe divide it into multiple properties. Because when you appreciate so much, laws change over time, but you can actually take a single family home that's been a rental and do a multifamily investment, or buy 2 properties, or there's all kinds of different things that you can then do with that one single investment that you started with, as it builds and builds and builds. And then, without having to pay the income tax on that money, it actually appreciates more and allows you to do more things in the future.
That's cool.
It's interesting.
Yeah, for sure. Kind of feel like we needed that when you sold your house.
Yeah.
Exactly. And I'll talk about it if you guys want. We can touch on the creative financing portion of it, which is my favorite. And we actually did a lot of this, myself and Amanda, this year, which was cool. And it also helped sellers that we were representing at times as well. But to kind of set the stage for it, we were coming off a market where property values, again, went really high, really, really fast. So there might have been a seller that couldn't sell at that time, but now they're using comps from a property that sold, record-breaking prices in their building or whatever from 6 months ago when the rates were lower. So let's say if we're looking at the Orange Beach area that Amanda was talking about before, a beachfront condo, and we saw a lot of price changes in the secondary markets, just as a side note, less on Long Island, for example, but an area like that, they actually did get a little price drop, right? So if you had a seller that really still wanted to get that price, and they're saying, my neighbor got 500,000 6 months, if I want 500,000, if there's a reason that they can't get that price because of the rates and there's less buyers in the market, for example, or the cost of having that place is just too high, the payment's too high, whatever it is. If you can creative finance, in other words, it might be other than just putting down more money, but let's say you took the property for sale for 500,000, the price that they want. You get a mortgage for 250. And then let's say instead of giving them 250,000 in cash, that mortgage from the bank might be at 8%. But now you'll finance the other 250,000 through the seller directly. So you do two mortgages, one for 250 at 8%, one for 250, let's say at 2.5% or 3%. Now you overall have a lower interest rate, a lower monthly payment. You can still give them that price at 500,000, and you can pay them monthly for that other portion. And you can get as creative with this as you want in a million different ways. But we've used this tool not only to purchase properties as investments to make them work. I bought a property that this person wanted this price. They would not let go of that price. So we threw it out there. Would you hold the note for 5 years? I'll pay you at 5% because the bank wants to charge me 9%. I can't give you that price at that. They agreed to it. And it's all about understanding what that seller wants, right? I know Amanda has brought it to a few sellers in her area that really wanted that price, and she came up with that solution to get them that number. Maybe they don't care about getting paid over time. They want that number though. They want that 500,000. And that's a way to do it. So when rates went up and prices stayed high, that was a good opportunity to still make deals work on both sides.
And it benefited both people very well.
Mm-hmm.
Yeah, I have no trouble saying I don't mind cutting a bank out and letting everybody else make that money instead of them. I'm all for that.
But you have to find that seller that is willing
Totally.
to take on.
Yeah,
your debt.
so situations where there is a lot of equity in the property, which again, in this market where a lot of people have a lot of equity is an ideal time for that. You know, we're in a very different market now, and I've been through, you know, the worst markets, which, you know, a lot of real estate agents weren't around to remember the short sale time when people had no equity or negative equity in their homes. And you know, that gives less opportunity for creative solutions, different opportunities, depending on, I guess, who you are. There's always opportunities. It's just a matter of who and how it comes to be. But for this opportunity, when we're in a situation where most people have high equity in their properties, because we're coming off of this time when property values went up so much, it works for a lot of people. It works for and not a lot of people know about it, and not as many people are using it as could.
I think that's the most important thing. So.
Yeah, I've never heard of that.
Mm-hmm.
Well, I mean, not so much as, I mean, owner financing, of course.
Yeah.
But not so much as the breaking it up and trying to convince your seller to take on a loan at a below market interest rate. But I guess I've never been doing this in a market where the majority or a lot of people have a lot of equity.
Yeah,
And that's the key. It doesn't work
in the
without
homes.
Yeah.
Right.
Yeah, I mean, there would have been a time when someone would say owner financing, and every real estate agent would say no. Like, you wouldn't even entertain it. You wouldn't even think about it. But this is it's a whole different game. And also on Long Island, the same thing. You know, it's an area where a lot of people stay in their homes for a very long time, and a lot of people have a lot of equity built up in their homes. And so again, it kind of goes back to that question we were talking about before. What is the alternative? If you're not taking that money, and you don't need that money to go and immediately buy another house with it, if that's not your situation, then there are a lot of people that owner financing opportunity actually works out even sometimes better for, because, you know, what were they going to be doing with that chunk when they got it? Where, you know, is it a matter of paying taxes or what else? You know, what else are they going to be doing with it? So.
Right. That's great.
Exactly.
So,
all day.
I'm sorry, Anthony, you were breaking up. What's that?
Oh, you go ahead.
Oh, I was going to say, so trying to apply these things to your great income rental spreadsheet.
Mm-hmm.
I've had a little difficulty with the spreadsheet, and I've done the tutorial, but that's just me. I'm sure I probably messed with it so much myself that I haven't been able to come back around
Okay.
to what it was originally. So I might ask that I get a new one sent over.
It's a good idea. We have to do that ourselves every once in a
mess
while
up.
too, Chris.
Do it all the
Every
time.
once in a while, we're like, we need a reset.
I think he was up till 2 in the
I think
morning
it's
one
a-
night.
Yeah, I think it's a garbage in, garbage out situation for me. I think I've messed with it so much that I'm not getting the full use out of it anymore, and I've attempted to write my own, and that's not good. Not
Well,
good at all.
the spreadsheet is very helpful for all of these different scenarios. And also, I was just going to add with the different things that we're talking about, the other great things to remember is they don't work individually. You know, they all can work together sometimes. You know, the 1031 exchange and creative financing both work together. And, you know, it's not necessarily that one's exclusive of the other. They can all be just pieces that can come to make some really good benefits.
Yeah, unfortunately for us, the 1031 is not going to work at this time, but maybe down the line, once we start getting into this, we'll have a little better situation with that. So
There's lots of time for it. Lots of time.
yeah, that's
It's
all
never
great. It's all great information. We really appreciate you spending time
Yes, definitely.
addressing this. What else do we have? Anything good?
Yeah, we got a couple more things. Should be great. All right, so we got
So we were talking about a little bit, which we actually haven't covered yet, what we think the lower interest rates actually going to end up doing in 2024, right?
exactly.
So, you know, we talked about what we expected to happen last year and didn't happen, and interest rates went up and prices actually still went up, just not as fast. Now we're actually seeing the interest rates that have been cut again. And again, the news is interest rates, except we're talking about it in the other direction. And I personally am very happy about this. I thought that they went up way too fast for anyone's good. But I think now they're at a really comfortable rate. I mean, we got very spoiled for a very long time. And, you know, obviously the interest rate being so low for so long actually did some other harm to our economy and other aspects, which someone out there is benefiting from. But I think that, you know, we're really at a more normal and over historically very stable place right now. And if we just continue to bounce along where we are this year, I think that would be great for our market. And we're really starting to see people just become more confident again, more calm again. And that is going to likely bring more competition back from home buyers and investors as well into the market. And one of the reasons why we might see that competition back from investors as well is because the numbers actually still look good for rental rates that we're hearing. Anything you want to add to the interest rate part of that, Anthony?
Yeah. So I think that I mean, the last couple of months, even if we go back, they fluctuated so much in this last year, which was tough, right? And there was just so much revolvement around the media with this that it was a little bit tough for things. But I think from my perspective too, it was just very difficult to make deals work with a traditional lending, with a traditional loan in place. It was very, very hard. And we're also coming from a time where banks in general and lenders were very, very strict on who they lend to as far as income checks and tax checks and overall asset protection, all this stuff. They made it very difficult to get a mortgage, right? And I actually was happy about that to try to avoid the whole 2008 thing. But it wasn't an easy process, especially for someone who's an independent contractor like myself. It was nuts, right? So if you add that with a really high interest rate and the whole process, it was very difficult to make deals work traditionally. But I'm hoping that, and what the media is all saying now is that as rates have come down a little bit and they continue to either not raise them or keep them consistent, it'll just become the new norm in the process, which I think will give, like you were mentioning, confidence with people, which just gives people some kind of confidence. Where when we've got buyers under contract, whether it's a buyer that was going to live in it or invest in it, we were doing numbers every which way for them. Well, your payment might be like this if the rate's there, or it might be like this, or we don't know, it might go up. Should we lock today? Should we not? What's the time frame like? It was a very unsettling process throughout this whole time. And as brokers, our job is to keep everybody settled and confident by setting expectations. And it was almost impossible to set expectations. I literally was like, call the lender, didn't even want to say a word because you could say one thing one day and the rates were different. So I think that with some consistency going into 2024, and people are more used to this rate, and banks getting more used to this and giving, lenders, even when they're speaking to clients, they can speak with more confidence about what the figures are. I think that'll just create a confident investor, and it'll help us being able to underwrite opportunities more, really look at deals, and might not have to move on them in 24 hours, but you can sit and digest them without knowing that your debt rate's going to change so much, which is great. And I think from the seller perspective, it also does the same, which might increase the amount of listings on the market, which would be great and opportunities wise. The sellers don't have that fear of, well, if the rates go down, my property's going to pop up or whatever it is. So consistency, I think, is key.
And I'm just going to give one opinion here, and this is pure opinion, but since we are talking about what other people are saying in the media and what other agents are saying, you also hear, I think, a lot of people say, oh, when the interest rates come down, prices are going to go way up again, and kind of using that as a tactic to maybe get people to act more quickly. I don't necessarily subscribe to that tactic. I think, when people are calm, when the rate is stable, when everyone is equally confident on both sides, we have sellers now that also become more confident and feel like they can move when they want to and aren't necessarily just stuck in their home because their interest rate isn't one that they want to give up, but they have other factors that are affecting their life that actually really want them to move. They'll be more apt to say, you know what, it just makes sense for me. And we're going to end up with just a little bit more of a balanced market in general. I personally don't subscribe to interest rates are going to go down and prices are going to start to skyrocket again. I don't think that's going to happen. I think it's going to be, maybe I'm overly optimistic, but a nice, more balanced, more calm. They might go up at a nice normal pace, of 3%, but not 10% when we see an interest rate drop, and then it's all going to be made up in home prices again. I don't personally subscribe to that belief.
Yeah, and I think that had a lot to do with how fast they went up, which is one of the first things that you said, which we talk about all the time. But how fast the rates went up and how they changed so rapidly created that. So if we're getting to a point where we're more at a consistent level, that will create that inconsistency in the market, and at least maybe allow sellers that are holding down the supply so much because they really are afraid to move because rates went down, whatever, create more transactions in the market and opportunities for buyers. And like we wrote down here, more competition, for example. Anytime that the rates are lower and there's more buyers in the market, there will be more competition. But I mean, everything that we're reading about how rates will stay in the mid sixes to the mid sevens on the user side, and maybe the mid sevens to mid eights on the investor side, I think that there's still going to be a lot less competition than if we're comparing to 18, 19, 20. So it might not feel like
the traditional lending perks too. Every Friday we have a call with our lender partners that kind of just fill us in on what they're seeing that week, what applications looked like, what they're feeling from their end and what's going on. And they often now, particularly with these rates having gone up, are coming up with all kinds of other creative solutions that exist for getting lower rates. Buy downs, seller concessions with buy downs, and these types of things can exist for in the investor market also. So it has opened up other potential options from lenders to do things that, they weren't doing a few years ago, which maybe you have to pay more for upfront, but depending on what your long-term goals are, can benefit you in terms of an interest rate or in terms of whatever those numbers look like, cash flow or anything else that is just good to know exists. So talking to lenders are our friends. There's all kinds of different solutions that are out there, and the information and getting it and having a great agent that either knows someone who is in that situation or can offer those types of things and hook you up with someone, those are all just things to be aware of. I think going to our bank is often someone's first thought of, oh, well, they know me, they know they hold my money, they know I'm good for it, is a common misconception. But the bank that we bank at on the corner is not necessarily always the best place to get money for real estate. Maybe it is, maybe it's not.
Yeah. Gotcha. Okay, do you mind, can we pivot for a second on our conversation about going back to something that we kind of started on and we didn't pull through? Anthony, you were mentioning about that in the past year, the Airbnb market was down of renters out there. Are you seeing, or should I not bring this up yet? Should I wait till the end?
No, this is
Can you
perfect.
just put another slide up?
This is it. This is it. We got it.
Okay.
No,
Well,
this,
then
yeah, sorry, I didn't
I'll
mean to
be
throw you off.
quiet. I'll be
No,
quiet.
I'm glad you asked, and that's, we wanted to talk about that today.
You were Johnny on the spot, Anthony. You had the slide. You made that so quickly. While I hadn't even asked the question yet.
That's what I was doing. I was ready to begin to go.
Very good.
So, I don't know if you guys even saw this, but we follow, and I follow a lot of I don't like Airbnb moguls, like on Instagram and Facebook, where basically that's their main portfolio. It's Airbnbs and short-term rentals, right? And if you're on any of the social media platforms, I can send you who these guys are. They're really great. I learned a lot from them. A lot of them were creating videos about pushing back on the media. I'm going probably back around 3-4 months ago, talking about how Airbnb and short-term rentals in general were down, right? But to give an idea of why that was, it really had nothing to do with the fact that there was still less demand. There wasn't necessarily less demand for short-term rentals, but we were coming from a time where there was so much pent-up demand from COVID that short-term rentals were at such a high level. And when it comes to restrictions of hotels and certain things, that it seemed like there was a drop off and there was going to be major less demand going forward. And this Airbnb boom was what all the hype was about, where really the demand wasn't there to support it. But it is, hold on a second, I want to blow that off for you.
Yeah, thanks. I had to put my glasses on.
Yeah, no, we couldn't fit them all, but I love this one. So I was like, let's go. You guys can still see my screen, right?
Yes.
Perfect. Hang on one sec.
I stole my
He's
glasses. Terrible.
Ah. All right, you don't need to see that. I'll move that after. But these are most rental locations seeing strong demand growth. We just got this chart, by the way. You can't really see where it's going on, but you can still see. So small city and rural cities, right? Blue is the short-term rentals, and gray are hotels. So obviously in small rural areas, it's not even close. Mid-sized cities, basically the same thing. Suburban areas, same thing, but you see a little bit more. And I think there's like look at Long Island, for example, just on that, there's a lot of hotels and they're decently affordable compared to like Manhattan. But when you go to the urban area, there we go. They kind of start to level out a little bit, right? But across the grid, there's still more demand that people are more likely to stay in a short-term rental in Airbnb versus they are in a hotel.
We were talking about that amongst us and with Beth too, that especially, and we can speak of this from firsthand experience for a family, particularly if you're traveling with 2 little kids and you have a hotel room with 2 beds in it, great, no problem. As your family gets older and your needs change, the expense of going from 1 hotel room to 2 hotel rooms versus an Airbnb, a larger Airbnb, I think, becomes a no-brainer for a lot of people that are traveling either with older kids or with families, or, once you get into that territory where you can't cram into one hotel room anymore. And in my opinion, that's one of the reasons why we're seeing some of these major shifts in people skipping the hotels and looking more for the short-term rental, privately owned options that give them more space, that give, older people more privacy, that give them a place that, maybe people can come and go to a little bit more freely, a kitchen, many of the other benefits that you have with a short-term rental versus having a hotel as you have more people.
Yeah, we're for example, Amanda and I we're doing a deal right now in St. Petersburg, Florida, and we're actually going down there right after Christmas, between Christmas and New Year's, and it was kind of a last minute thing. I checked every place possible. I'm also going down with my wife. We checked everything possible. Obviously, that's a crazy time to be in Florida. I think half of New York goes to Florida in that time period. But there was a lot of hotels available, but the pricing was nuts because of the week for a nice place, right? And I think we were looking at spending probably for 5 nights, like $2,500 to $2,800 for a basic room, but a decent hotel, right? Going down there to flip a house, I'm like, this isn't a part of it. We're like, let's check what we got in Airbnb. Because I don't want to go down there and stay at a crap hotel, right? Check an Airbnb. We're at like $900 with taxes and everything for a beautiful 2-bedroom, 1 block from the beach. Wasn't even close, right? And I sometimes I like to stay in a hotel personally, because they come and they make the room and they do all that stuff.
Yes, me too.
Yeah, that's what I like, right? Where my wife doesn't care so much. But the point is that I just saw this yesterday where it wasn't like a couple $100 difference. It was $1,500, and it's not like I'm going to Disneyland. I'm just going to a general area in Florida. But
yeah,
that's it.
Yeah, makes
and
sense.
it opens up so many options for so many different types of situations. Okay, 2 people that aren't family traveling together, not necessarily sharing a hotel room, but sharing an Airbnb, great. Okay, you have 2 cars that, you're in an urban area, you can't park very easily, but can you park at an Airbnb 2 cars? Yes, like there's so many different types of scenarios that I think really come into play. And that's why we see this demand for Airbnbs overtaking the rise of demand overall from the hotels in a lot of most areas.
I keep reading these articles about squatters, and these, and I don't know if there is as many out there as I'm reading about. I just, that worries me that someone could do a short-term rental and just stay in the rental property and you can't get them out. And each state has different laws, as you know. Right. And maybe I'm reading too much, but that's a concern. That's what I worry about.
And that's 100% valid. And I think that it's always been a thing in states that are, let's say, more tenant friendly. And then Airbnb just gave anybody that wants to take advantage of a landlord that perfect opportunity, because the ability to get into it, right? There's no what's the word for that? Basically, qualification wise is not even close to having to put in a rental application versus it is for an Airbnb. Anyone can really do it. So you open it up to yourself to that type of risk. But I think that at the end of the day, it's the same thing for buying with a long-term tenant in a certain area. There's certain risks associated with that investment, and you're going to have that in Airbnb. But most of the time, and I say this to Amanda all the time, because we're always looking at all these different things. When it comes to owning and operating an Airbnb, I want it to be almost double the return that I would get for a long-term tenant, because not only is there more time involved probably, but there's more risk involved. And when it comes to investing, like that's really what you're looking at, right? So if I'm looking at a 10% return for a 12-month tenant that I want, if for me to Airbnb that property personally, other people might not agree, I wouldn't do it for less than 20%, because of that type of risk, or the risk that someone can have a wedding and bring horses in the yard. I don't know. I've read all those articles. Like, it's not. Some guy.
I don't like risk, and Chris is more of a risk taker. I think you are more. So I worry about all of these things.
Well, I think there's so many discussions too that can that can lead to, and maybe that should also be a topic for one of our other seminars. But you know, there are all types of Airbnbs, just like there are all types of long-term rentals and you know, other types of investment properties. But there are Airbnbs that cater towards, you know, of different types of clientele. And generally speaking, the ones that make the best returns are the ones that actually charge more money and have more amenities, and that people do you know, the crazy things too. Like, you know, you have a theme throughout the whole place, and you know, they know that if you have a bachelorette parties there, that they're really catering towards people that are coming for bachelorette parties. And you know, there's a whole science on the service and the hosting that comes along with Airbnbs that just they're different. It's a different type of a business, I would say, or it can be a different type of a business depending on where you are and the type of investment that you're looking to make as well.
Yeah, this graph shows pretty clearly what we were talking about, guys, too. And we can send you any of this if you want. I'll text it to you. But we were talking.
You see us both leaning
Yeah,
in.
please do. Please do.
Can you see okay?
Oh,
yeah.
yeah.
All
Now
right.
I can't see what I'm looking at.
But if you look, so this is AirDNA is it's used for a lot of things, but really it's basically compute stats for Airbnb properties and VRBO. So if you just look, these are the different types of locations: 2019, 2020, 2021. If you look at the jump during COVID times, right? For any property to grow that amount, that's insane. The average property value grows 2 to 3% a year, 24%, 12.8%. And then in 2022, 2023, the things came down a little bit. And this was the first time ever, I haven't looked at every stat in the last 30 years, but whenever Airbnb started, maybe 15 years. But the amount of growth here is that's the only reason why this was kind of dropped off a little bit.
Anthony, is that gross growth, or is that profit?
I think
what are we looking at?
It's the revenue performance.
Okay, so that's
just the amount, just the amount of revenue,
just the money coming in.
right, year over year. And
how much of that do you think you can contribute to a rise in price of the property as opposed to volume?
I think it all has to do with volume, probably, because I think that actually it's probably a mix of both. I mean, 2020, I would say volume probably had. I mean, they go hand in hand at the end of the day, right? And a lot of people have. Amanda, you might need to help me on this. There's an app that you can download onto your Airbnb and it partners with it, and it's called dynamic pricing, and it'll basically change based upon the competition automatically with artificial intelligence. So it'll set pricing for you, and I think it's like $10 a month. Basically, everybody on Airbnb has that, so it's already changing based on what's available or not available. But I think that this had more to do with probably volume and occupancy rates, especially in 2020, where everybody was trying to get out of their house. And then we probably saw over to this, but these numbers of any kind of decrease in revenue year over year. This was the first time that Airbnb saw any of this. I mean, look at their stock over the last couple of years. It's been nuts, right? So the point is that the media love to talk all about this, but this really only had to do with the previous years and the pent-up demand.
And one of the things that we were also talking about with that is, you know, again, as far as being an Airbnb manager owner, there are different styles of management and different levels of involvement of the owners. You know, some people just put their property with a property management company who also uses Airbnb and VRBO. And now, you know, it used to be kind of separate, that the owners used VRBO and the management companies used their own thing. Now they all use the same ones. If you're managing through a management company, they absolutely have your property on Airbnb and VRBO. And if they don't, then you should probably find a new management company. But because of that different levels of involvement, the more involved owners are going to be paying more attention to the market, more attention to pricing, more attention to what renters are demanding, and making changes and pivoting more quickly, and their units are going to perform better. So it's also an indication of the importance of knowing what's going on in the market, and if prices do dip down, that you've changed your prices. If if what's the competition doing, you don't want to be the person that gets left in the dust if prices went down because whatever was going on. One of the things that they said was that over the last year, from 22 to 23, people waited a week longer to book. So if you were sitting back and you're watching your rental, every single day, like, okay, this event's coming up. I know Memorial Day is always booked and no one's in it. Well, guess what? It booked a week later. And so maybe people dropped their rates or maybe other things happened. I don't know exactly what the specifics are of what you could have or how you could have or should have reacted to that particular event. But those are the types of things that affect of an owner of an Airbnb, and knowing that, okay, just because you weren't booked the same week the week before, it was going to book this week and you didn't actually have to drop your rates, that it was going to book for the same or even the same increase, but it was going to book a week later.
I think the big one on that too, and I've been using Airbnb probably since it started for a very long time. You used to see, like, let's say there was 15 houses you were looking at in an area. Maybe 5 of them had professional photos and looked staged, maybe. Now it's like every property you look at has professional photography. It looks like it's been staged, it's been renovated, it's designed, because there's more competition in the market. And that's it. Used to be able to have, like, I'm sure, Beth, you could talk about this in Mount Snow. I don't even know if you can Airbnb there now, but when they started to do that, I have some friends that are there. They literally put a bunch of junky cell phone pictures of the outside of the house, but because of the location, everybody wanted it because there wasn't much competition. Didn't matter. They could rent it instantly. Now they have like professional photos and this because the neighbor's renting and they're offering this and who has a hot tub, and there's just more competition. And this article we were reading was just talking about how with more competition, you have to be bet more on your game and just kind of up the level a little bit. So
Yeah.
In order to get
One
the best
thing
returns, at least. If you want the best returns, all those things start to come into play more.
Yeah, I have noticed that the amenities make a tremendous difference.
Yeah.
In what you're going to get on a nightly rate. And having been in the hotel business as well, I know those add-ons definitely help in the long run. So, just so you mentioned the hot tub or the swimming pool or the golf cart or things like this, the boat launch in the backyard, yes. Right? Things like that are tremendous.
Yeah.
Definitely.
But contrary to a lot of the Airbnb bubble stories, it's actually showing that the short-term rental market is going to continue to be a very strong market in 2024.
Yeah.
Very good.
So we're at 6 o'clock, Anthony. Anything else you want to share with us before we wrap this up and let everybody wrap their Christmas presents or drink some eggnog?
Bake some cookies.
Bake some cookies.
That's what I'm talking about.
Come on over.
I don't think so. I think we're good. We touched on a lot today. And it was nice to throw this together during the week of Christmas, which is crazy for us and everybody, I'm sure, obviously. So it's nutty. I think that we definitely want to get somebody on, which I know we were talking about some before, Amanda, that operates several Airbnbs, has a full process down for it, because you and I have dabbled in it, but do you still own that place or no? Are you Airbnb in that?
No, we sold it.
Sold it, right? So, and I don't have any Airbnbs right now either. But we definitely want to get somebody on who's operating them at a large level right now and see what's going on. And they can also talk about demand and everything else because they have probably multiple different markets. I have a couple of people I'm going to reach out to see. but that would be a fun one. So
Yeah,
That'd be great.
yeah, we'll get that on for sure.
there's so many different topics that and each time, you know, we want to go deeper and deeper into each one. So, you know, that's why we do it every month, because it just gives us an opportunity to kind of go a little bit deeper in one of those directions. So we'll keep you posted on next month, what our deep dive's going to be and who our guest is going to be. And I think this was a great way to wrap up 2024 in a positive way. You know,
Yep.
from where I sit, it's a lot more positive, I think, than people were expecting when we were sitting here wrapping up 2023.
For sure. Don't listen to the media. That's what I have to say about real estate.
Yeah.
That's why we're here.
Yes.
Exactly.
Rather hear
All
you
right,
guys.
everybody. Have
All
a
right,
good
thanks
Thank
so
you so
much.
much for joining us.
Appreciate it. And thanks for the Christmas party. We appreciated it. That was
Yes,
great.
it was wonderful.
It was great to see you guys.
Okay, take
Thanks,
care.
everybody.
All right, my
Bye-bye.
friends. Be well.
Bye.
Bye.